IAS 12, income taxes. The objective of this IAS 12 is to describe recognition and measurement rules for income taxes in financial statements. The component of tax expenses. So we have two components of tax expenses, right? Current tax and deferred tax. We know what is current tax because we all also studied in financial accounting, but most of them may not know about deferred tax. IAS 12 covers the accounting for both current and deferred taxes. Now, what is current tax? First of all, we will look at again and refresh our minds about current tax. The tax charge for the year based on taxable profits, right? And what you do when you charge current tax, debit income tax expense and credit current tax payable, right? Or if you straight away pay it, then cash. Calculated using the enacted tax rate on taxable profits. So you calculate the taxable profits and you use the tax rate that was enacted, means that established by government, right? Taxable profits differ from accounting profits due to tax laws, right? Because in taxable profits, because the tax legislation may not allow you to deduct some expenses, right? But in accounting profit, you anyway need to deduct. Let's say maybe you are doing some provisions, right? And by tax, it's not allowed, right? So that's why accounting profits will be different from taxable profits. All right. What is under and over provision? So what you do first, let's say when you are just closing your financial statements at 1st of December, right? You calculate your current tax as an estimate. So current tax is initially estimate, right? What you do in this case, you just calculate some amounts, right? And you make an estimate of current tax. And then you, after everything is done within your financial statements with all the figures, right, in accounting, you have final amount, final taxable profit, and final tax amount, right? First, you calculate estimates, and then when you have final one, you make adjustments. Depending on the first amount, if you made first estimate higher than the final tax amount, then you have over provision, right? In this case, you need to reverse this expense. But if your estimate that you did in the beginning is less than the final tax, then you have under provision. Then you need to charge additional expense. All right. Let's look at this example. So we're going to look at this example now under and over provision. At the year end, income tax on profit was estimated to be 10,500, and you did this journal entry, income tax and income tax payable. Then income tax for 1 year was settled as 1,700, right? When the amount is paid in year 2. So in year 2, you are doing this. You are paying cash, right? Because you closed already first year, right? And it's happening already. Let's say you are paying for tax, not straight away on 31st of December, right? You are paying it in March. You are paying cash 10,700 because you calculated already final tax. And you are closing your income tax payable, right? But in this case, what you should do in order to make it 0, right? Because you don't have tax payable already. But if you are charging this, you have a debit income tax payable. So, and on credit, you close this income tax payable that you recognized here, the difference between them, and income tax expense you recognize. At the end of year, income tax profit were estimated, and now next year you are estimating again 11,000. Based on raw calculations, you charge income tax expense, income tax payable, and then you paid because of the final final calculations. You paid 11,200. Okay. Mm. So what happened here? Um, Now, in the year, total income tax expense in the statement of profit or loss is 11,200. Because of this and charge this, right? You may have an income tax expense 11,200, right? And the income tax for the year 2 was settled 10,700. Now, for the second year, right, settled when the amount was paid in year 3. This amount was paid in year 3, cash, and this amount. And what is the difference between 11,000 and 10,700? 300, right? So this 300 you are deducting because you charged 11,000, right? From your income tax expense. So you are decreasing your income tax expense by 300 and income tax payable as well by 300. So this is how it works. So you have always estimate and final numbers, under and over provisions. So you have under, then you need to charge more. If you have over, then you need to decrease the income tax expense. Okay. Now we will talk about deferred tax, right? The purpose of the deferred tax is to align tax expenses with accounting income via accrual concept. So accrual concept says that all the taxes that is related to expenses, right, which you have within this period should be also matched, right, together. Just because if you are paying some other amount because of the tax legislation and you are charging other amount of tax, so you should also correct this amount as a deferred tax. Deferred tax arises due to only temporary differences. There are two kinds of differences, right? Temporary differences and permanent differences. So we need to also distinguish these terms. But the deferred tax arises due to temporary differences. Temporary differences, it means that you charge now, but let's say by the tax, it's allowed to charge next year. So these are temporary differences, right? Now you charge, and by tax you are allowed to charge later. Now you can charge one amount, and tax allows you to charge another amount only. This is permanent difference. So the tax legislation does not allow you to charge the differences later, right? So this is called permanent differences. Permanent differences, they will not be covered in the future. They will always exist, right? And that's why you can calculate the deferred tax only for temporary differences, which may in the future recover. So the temporary differences are the timing differences between recognition in financial and tax records. So for tax purposes, let's say allowances should be calculated using 5%, right? But your company's policy is to use differently, to calculate differently this allowances, right? In this case, this is not the timing difference, right? But if, let's say, depreciation, so you have one amount, the same amount is allowed by tax, and just tax legislation tells you to use straight line basis, and you are using reducing balance method. Just because of using reducing balance method, in the at the beginning you have more taxes, right? Than your tax records. So in this case, this is timing difference. Anyway, when you depreciate over the full life of your useful life of your asset, they will recover each other, right? Not applicable to permanent differences, so temporary differences and deferred taxes, these are the related terms. So we're gonna look at this example, depreciation tax versus accounting now. Remaining non-current assets are depreciated. Most tax authorities will allow businesses to deduct the cost of purchasing non-current assets from their profit for tax purposes, but only accounting to a set of formula. Only according to a set of formula. For example, Moscow buys a machine for 10,000 and starts depreciating it over 10 years useful life. Tax authorities allow all companies taxable expense each year equal to 20% of the cost of an asset. The cost of Moscow new machine is recognized as an accounting expense at a rate of 1,000. So you just divide, right? 10,000 by 10 years per annum over 10 years, and taxable expenses at a rate 2,000. So because tax authorities can allow you only 20%, right? So you just take the 20% for tax purposes. And for your accounting purposes, you take 10 years, right? For your accounting purposes, when you take 10 years, you have depreciation of 1,000. And for tax expenses, you will have 2,000. Over 5 years. This one is over 10 years, this is over 5 years. So you have timing differences because you are depreciating for tax purposes faster, and for your accounting purposes slower, right? And the full 10,000 cost is recognized by both tax authority and the business but at different rates. If the first 5 years that Moscow owns the machine, the income tax expense is calculated on taxable profits that are 1,000 lower than financial reporting profits. In the remaining 5 years of the machine's useful life, the income tax expense is calculated on taxable profits that are 1,000 higher than the financial reporting profits, right? As a result, income tax charge appears out of line with the reported profit before tax, too low in 1 to 5 years, right? And too high in years 6 to 10, right? And this matching principle here doesn't work. And that's why they created these deferred taxes in order to match, because they are saying, you see, you are deducting 1,000, but at the same time, you are applying more, you are calculating more taxes first year, right? And less taxes because reported before tax is too low, right? First year, and so this years you have less income tax. This years you have more income tax. But in your accounting, nothing changed. You are accounting only, you are charging only 1,000. That's why you have this deferred tax for these differences. Deferred tax addresses this by creating additional tax expense in the year first, in the year 1 to 5, and the tax credits in the year 6 to 10. So in order to smooth the results, right, it creates additional tax, deferred tax, right, for the first years from 1 to 5, and it decreases the tax from the years 6 to 10. Okay, this is the purpose of deferred tax. And for deferred tax calculation purposes, we use balance sheet method, balance sheet approach. What is balance sheet approach? We are comparing carrying amounts per our accounting and comparing tax base. So carrying amount, let's say, of our asset and tax base. And the differences between them we are calculating. And depending on those differences, if they are positive or negative, we calculate deferred tax liability or asset. Okay, what do we do? Let's look at this example and we will understand how it works. This is a big example for the deferred tax, this principle using this balance sheet approach. Tom Cole bought a non-current asset on 1st of January 2006 for 9,000. This asset is to be depreciated on a straight line basis over 3 years. When accounting depreciation is not allowed as a taxable expense in the jurisdiction in which the company operates. Instead, tax allowances are available as follows. So tax allowances are available, right? 4,000, 3,000, and 2,000 for these years. The tax base of the non-current asset is equal to its initial cost less cumulative tax allowances. So we are just looking at our This is tax allowance, right? That are allowed. So you are just charging straight line basis 3,000 each year, yeah, right? Your carrying amount is first year 6,000, second year 3,000, and the last year 0 because fully depreciated. And tax base. So this carrying amount, just because of they are allowing these ones to be deducted, right? 4,000, 3,000, 2,000. You are first year deducting this amount, you have carrying amount this. Second year you have this carrying amount and 0 the same. So here we have differences, right? Temporary differences. So 6 minus 5, 1,000, and 3 minus 2, 1,000. Temporary differences. There is no temporary difference at 1st of January because the carrying amount and tax base are equal. So at 31st of December 2006, the carrying amount of the asset is 1,000 greater than the tax base because the depreciation expense was less than the tax allowance. It gives the rise to temporary difference of, this is described as taxable temporary difference. Taxable difference arise when your carrying amount is more than tax base. So we have two types of taxable and deductible temporary differences, okay? Taxable, it means you charge additional on this one, right? Tax. And deductible, it means that you are deducting, not charging from your additional to your tax. So in December 2008, temporary difference has reversed, so no longer exists, right? Here, where 2007, you have again taxable temporary difference because the asset will generate income in the future. Benefit from further allowance. Net 1,000 will be taxable. Here, temporary difference has reversed, so you don't have any temporary difference here, right? You have 0 temporary difference at the end of the year. 3, right? So there is no difference now here. So if the carrying amount is more than tax base, then you have temporary differences. Temporary differences, taxable temporary differences. But if it was vice versa, 6,000 minus 7, deductible, you would have. Okay, how we calculate the deferred taxes? Deferred tax, as we talked already, right? In order to calculate deferred tax, we just take this temporary difference and apply the tax rate that we have. All right, let's look at this example and calculate this deferred tax. So the temporary differences have already been calculated. So they calculated already for us temporary differences, right? They showed from the previous example, this 1,000, and tax rate is 30%. So the deferred tax will be 300 and 300, right? For the first year and for the second year. And for this the third year, we will not have any tax. At 31st of December 2006, there is a taxable temporary difference to this one, right? Because more tax will be payable in the future years. And 30% is applied. All right, and what we do then, the liability is recognized, right? And what we do, what kind of entries, right? For liability, right, in 2006, 300, we need to make a liability. That's why we charge deferred tax expense and deferred tax liability 300 for 2006, right? And then next year, 2007, again, we should have liability of 300. We already have this liability. That's why no accounting entry is required. So we don't have to charge again to 300. It means that you need to have in your balance 300 of deferred tax liability. Okay, you already have it because you charged it in 2006. That's why nothing is required here. And 2008, you need to have in your liability 0. And what you should do in order to have this liability 0, you need to reverse it, right? So credit, deferred tax expense, debit, deferred tax liability. This is how it works. So you need to understand these amounts are the liability and the balances that you need to have at the end of the reporting period, not the charges. So these are not the charges. These are the liability amounts that you need to have. So if you have first year 300, next year 300, and third year 300, you need to just charge here, and that's it. And this year's, you need to charge the difference. And let's say if you had here 400, right? You would have here debit the deferred tax 100, and deferred tax liability 100 credit you would have, right? So please remember that these are not chargeable amounts. These are the balances that you need to have at the end of the period. All right. Now let's look at financial statements, how they will look like and how you will present them in your financial statements. So in the statement of financial position, you will have a separate line item, which is called deferred tax liability. So you will have here 300 because of the year balances, and here you will not have anything. In the statement of profit or loss, you will have, let's say, profit before tax, income tax, right? And income tax expense that you calculated, profit after tax, right? Then income tax expense, you should divide into two because you have income tax on profits and deferred tax. And they make together your income tax expense, okay? Income tax on profit, this is the one that you are showing to your tax authorities, and you are payables are payable amounts are also based on these ones, right? And you have deferred tax. So first year you charge, next year you don't charge, and then you reverse it, 2008. Okay, as a result, as you see, smooth income tax expenses, you have for 5,100 here, 5,100 here, 5,100 here. Okay. So you are smoothing the effect on profit after tax, as you see here, right? In order to avoid those fluctuations. This is the deferred tax purpose, okay? If you didn't, you would have this, right? If you just show this tax allowances instead of the deferred tax, right? You would just tax allowance, you would calculate this one, taxable profit, and your tax would be 4,800, 5,100, and 5,400. Just this effect, right? You are smoothing using deferred tax. This is the purpose of deferred tax. That now deferred tax in financial statement, how they look like, right, in our statement of P&L and in our statement of financial position. And now we'll look at tax base. What is tax base? Tax base is the amount deductible, taxable in the future. So you need to calculate, first of all, determine this tax base of an item, then compare tax base to carrying amount to calculate different differences that we did in our example. As you saw, tax allowance were different than those depreciation amounts that company was charging, right? Then apply on the differences, right? The tax rate to calculate the deferred tax balances. So you calculate the deferred tax balances if they are carrying amount is more than tax base, right? Then you have a liability, right? Deferred tax liability. Recognize the change. If vice versa, then you have tax as deferred tax asset. Recognize the change in the deferred tax balance as tax expense or credit in the statement of P&L. So we did also this. These all steps we went through already. To better understand what is tax base, we can look at this example now. ABC Co. has 3 assets: a factory that costs 900,000 and has a carrying amount of 800,000. To date, it has received tax allowance of 270,000. The trade receivables with a carrying amount 100,000, the associated revenue was already taxed. Interest receivable 80,000. The interest will be taxed when it is received. Now we will look at each one, at each of them one by one. So what about the factory? The tax base of the factory is the amount that will be reduced taxable profits in the future. The factory cost 900,000 and the tax allowances to date 270,000, right? You should deduct from this one, this amount, right? And you have tax base this. It means tax base means that on this amount, you will calculate, based on this amount, you calculate tax, right? Trade receivables. The trade receivables will not generate taxable income in the future, so their tax base is the same as their carrying amount of 120,000. So in this case, the receivables carrying amount, right, is the same for tax purposes. Interest receivable. The interest receivable will be taxed in the future. The tax base is therefore the amount that will be deductible for tax purposes in the future. Since there is no future deduction, tax base is 0, right? Here, interest will be taxed when it's received, right? So for now, this interest receivable is not tax base, so tax base is 0, right? When it happens in the future, when it's received, then it will be taxable. Now, this was tax base of asset, right? Because we are using balance sheet approach, we need to understand how to find tax base for assets, and for our liabilities, right? Now we will look at the tax base of liabilities. How to find the tax base of liabilities. ABC Co has 2 liabilities. 40,000 accrue for overheads. The overheads have already been recognized for tax purposes as an allowable expenses. You have now its accrue, but it's already recognized for tax purposes. So its carrying amount less any future account that will be deductible. Since the tax deduction has already been given, no amount is deductible in the future. So the tax base is equal to the carrying amount of 40,000, right? Since the tax base is equal to carrying amount, there is no temporary difference, right? No tax, deferred tax on this one. There is no deferred tax on this one, right? Okay. 75,000 provision for legal claim for damage. So you made some provision, right? Any damage are given tax relief when they are paid. So they give tax relief when they are paid only, right? Not when you provide. So there is no tax base. No? There is no tax relief base. No tax base for this amount. When you make this provision, in your tax base, you will have 0. So you will have here 75,000 and here you will have 0 tax base. But these are temporary differences, but because they are associated with the tax, so somehow they are accepted by the tax authorities. If they said that 75,000 provision claim will not affect anyhow the tax, and it is not, let's say, accepted by tax authorities for expenses purposes, right? You wouldn't even include it into deferred tax calculation because it would be permanent difference. It wouldn't be temporary difference. So you need to also understand what is temporary difference and permanent difference, right? Permanent is something that you do, let's say you expense it for accounting profits, but your tax authorities does not allow you, right? Let's say you have some expenses such as you are giving gifts to your employees, right? But for tax purposes, you have only for tax purposes, they are non-deductible, right? If they are non-deductible for tax purposes and deductible for your accounting purposes, then they are permanent differences, not temporary. To be temporary difference, both of them should be like allowed. Should be allowed by your company, let's say, and by tax authorities as well. So we will look at now what are the temporary differences in more detail. So the differences between the carrying amount of an asset or liability and its tax base. Let's look at this better. So when temporary differences arise, they arise from differences between carrying amount and tax base, right? So two types, they may be taxable temporary differences, right? In this case, you will have deferred tax liability, as we saw in our example already. You had that. But if the carrying amount is less than tax base, you have deductible temporary differences, not taxable. In this case, you will have deferred tax assets. And when you calculate the deferred tax, you should apply expected future tax rate to temporary differences. So if you know about the expected future tax rate, let's say now you are preparing financial statements for 31st of December 2024, right? And the tax rate was, income tax rate was 15%, but they already announced for the next year 16%, right? Then you should apply 16%. Use enacted rates at the reporting date. Do not discount deferred rate and deferred tax. All right. So this is the one that I showed you already. So when carrying amount is more than tax base, then you have taxable temporary differences, and tax base is if it's related to asset, right? Taxable temporary differences. If it's related to liability, then deductible temporary differences. If its tax base is more than carrying amount, then you will have in asset deductible temporary differences and in liability taxable temporary differences. So this is also important table that summarizes what arises. Okay, now we can look at this activity of the temporary differences. So you have, let's say, tax base, right, for this one, then non-current assets, right? Property, plant, and equipment, but for these ones, you don't have, right? Tax base. Revenue is taxed when it's recognized, interest is taxed on the cash basis, and fines are not deductible. So you have these fines, this, and this, right? Fines are not deductible, it means that just temporary difference, right? Let's look at this one now. Carrying amount. So you have here for the tax base the same, right? This one is temporary difference 25. Then you don't have any difference here. Interest receivable. Why? Because interest tax on the cash basis, right? So for the tax base, you have 0 in this case, right? Only when it's on the tax basis, on a cash basis. So when it's received already, then it's taxed. That's why now it's not taxable, just if it's receivable. That's why tax base is 0 for this. So here you have 1,000 temporary difference, that's why. And they are saying that fines are not tax deductible, right? So for tax basis, that's why you have 10,000. The same. Temporary difference is 0. So this one is taxable temporary difference, because these are positive ones, and these are positive ones, and these are related to assets. As you see here, I'll show you again. For the assets carrying amount more than tax basis, taxable temporary differences we have, right? And if the carrying amount is more than tax base for liability, then you have deductible temporary difference. So carrying amount here more than tax base, right? That's why we have deductible temporary difference. So what you do in this case, you just take these amounts, right? For the first year, these, and these, sum of them, apply the tax rate, and you will come up with the, in this case, if it's taxable, 25 plus 1,000, 26,000, right? And you will have 24,000, right? Taxable temporary differences. So you will apply the tax rate, and you will have deferred tax liability, right? You need to charge if it's the first year, you need to charge if it's not the first year, then you need to look at the balances of the last year and just charge the difference between them. So in the tax rate example, let's look at this one. Tomco has an asset with a carrying amount of 5,000 and the tax base of 3,000. Tax rate 25% would apply if the asset were sold, and the tax rate of 33 would apply to other income. So they have different tax rates, do you see? For one type of income, for another type. So for assets that were sold, they would apply 25%. That's why you need to divide. So the one that is related to the assets, all right, when they are sold, 25%, and for other income, 33%. But these ones will be given for you, of course. So that's why for the assets, you are applying 25%. Okay. Note, IAS 12 does not permit a deferred tax balance to be discounted to reflect the time value of money. This is because of the complexity of determining when temporary differences would reverse. So it's complex, right, to understand when it's going to reverse. And if you calculate even without this timing difference, the deferred tax is very complex itself. And that's why in order to not to make it more complex, they don't apply here time value of money, even if you know that it's going to happen in the future, but you don't calculate and discount those amounts. Revaluation and deferred tax. This is also important to understand what happens when you have revaluations. When entity adopts a revaluation model for property, plant, and equipment, revaluation surplus gives rise to additional taxable temporary differences. Why? Because your carrying amount will be more, right? Your carrying amount will increase. And revaluation is generally not reflected in tax computations. Therefore, it does not affect the tax base. That's why additional taxable temporary is just you take the revaluation surplus as additional taxable temporary difference. Okay? So let's look at this example of the revaluation. Let's say you had the carrying amount, 1,000, depreciation, December the 31st, you have carrying amount of 900, and revalue your asset to 1,250, and the tax base is not affected by the revaluation, just you apply 30%. So what does it mean? You just here, for the tax, deferred tax calculation, take this carrying amount, 1,250,000 minus tax base, 650, and then temporary difference will be the difference between already revaluated amount, right? So you just take this amount, revaluated amount, and tax base will be 650, as you have here. Because for tax purposes, you have different depreciation methods, right? So you just don't do anything with your tax base in this case. You just take the carrying amount, a new one, and apply this new one, right? Calculate the temporary differences between them, calculate the deferred tax because it's 30% tax rate, right? And you have here for B, they are saying, assuming the company only temporary difference relates to this asset, construct a note showing the movement on the deferred taxation. So how we show this movement in our disclosures, they are saying, we need to show this way for the deferred tax purposes. We should first show 1st of January, what was our 1st of January deferred tax based on these figures, right? 1st of January, we would have this, and we would have deferred tax of this if we apply 30% the same. To other comprehensive income, other comprehensive income, we will have the difference between this one and this one because we did revaluation, right? This is the revaluation surplus. So we are showing because of the revaluation, we would have also 105. And then balancing figure or 150, or you can just put here balancing figure to make it 180 because here you need to have at the end of the period 180, right? Or you can also calculate it yourself. 150 minus 100, you will have 50 multiplied by 30. Where we get these numbers? These are the numbers: tax base, carrying amount. Okay, so this is called B, as you see here, as the movement that you are going to show in your notes. So in your notes for deferred tax, you need to show the movement. Movement means that from the beginning, how your deferred tax changed, right? So in the beginning, it was this one. Then because of the revaluation happened this one. And the other things, because of this, your depreciation was different. You have this difference, right? If you didn't have revaluation, you would have only 60 and 15, and at the end you would have 75. Just you are dividing all the differences between OCI, which means that revaluation surplus, right? And between your depreciation amounts per tax base and per accounting. All right. This one we looked at already, right? How to show the movement and how to calculate if we had the revaluation and how it affects the deferred tax. Now we need to look at tax losses and deferred tax. So some tax losses can be carried forward, right? So for some organizations, let's say as an incentive, maybe government allowed to carry forward their losses. What does it mean? If you have tax losses this year, you can carry forward to the next, let's say, 3 years, right? In this case, we need to recognize deferred tax asset if future taxable profits probable. So if we know and we have an estimation that we're gonna have in the future the taxable profits, then we need to recognize our deferred tax asset. If no, then we should not recognize deferred tax assets at all. Okay? So what does it mean? Tomaszewski has tax losses to carry forward 90,000. So it has tax loss and it is going to carry forward it, right? In the future, to recover it in the future. And the following information relates to the company, right? Carrying amount of the non-current assets and tax base. Further information. Tax rate is 30%. Company is very confident about the trading prospects and the beyond due to the new contract that has already been signed with a major customer. Budgets indicate the profit. So for the next year, they are saying per annum, right? From 2007 to 2009, they will have 120,000 profit. They are budgeting it, they are estimating, right, in the future. What we should do in this case? We will look at now the differences, right? If we have, like, let's say, deferred tax asset, and if they have this amount predicting in the future, then we can recognize deferred tax asset. If they would say here they are not sure about their future profits, we shouldn't recognize deferred tax assets. Okay. So in this case, we're going to have deferred tax asset, right? Because non-current assets minus 4,200. We're going to have 40,000, and then we have losses, right? And deferred tax asset at 30%. And we have 15,000 of temporary. These are the temporary differences. Why? Because we have this one and then also deductible this one, right? And we have, because of its minus, we have deferred tax asset, right? And we apply on this 30%, and we have this amount, 15,000. So on the temporary differences, we apply 30%, and we have this amount of deferred tax asset, right? So, and we can recognize this one in this case because they are expecting profits in the future. If in the case, right, in the problem that you are going to solve in your exam or in the future, just to practice, if you see here that they are not expecting any profit, then you should not, if you calculate it and you have deferred tax asset, you should not recognize this one. All right. So this is the main thing about the losses that are carried forward in the future and how they affect the deferred taxes. All right. So, so far, we learned with you about the deferred taxes, identifying this carrying amount and tax basis, right? So the carrying amounts we take from our financial statements and tax basis we take from tax legislation. So we can say even why, because if they allow one amount for our assets for tax purposes, if they allow one method for depreciation, or the useful life they may allow different from our accounting policies, right? Then we have differences between carrying amounts and tax bases, right? And we looked at what are the temporary differences. Temporary differences are those ones that are allowed both by tax and by your financial statements, but in the future, you know that you can recover it, right? So just because of the timing difference, you have your profit different and taxable profit different. And after computing your temporary differences, you just apply tax rate to each differences. And depending on what you have temporary tax taxable temporary differences or deductible temporary differences, and depending on if you are calculating it on assets or liabilities, you have then deferred tax liability or deferred tax assets, right? So deferred tax assets you don't recognize if your company has losses that are carried forward, but the company does not expect in the future any profits, right? If your company expects in the future profits, then you recognize deferred tax asset, but deferred tax liability you can recognize as well. Compare with opening balance to derive expense and credit. So now you know that the amount that you're calculating after this applying tax rate is the amount that you should have in your balance as tax liability, deferred tax liability, or deferred tax asset, right? So if they have differences between them, only those differences go through P&L, right? As a deferred tax expense. But if they don't have any differences between the previous year and the current year, or the current year and the future period, then you will not recognize any deferred tax expense. Only if they have differences between those balances that you found. So the amount that you are going to find going through these steps will be the balance that you are going to have in your financial statements as deferred tax liability or deferred tax assets. Okay. So let's, we have almost finished. So what is current tax? Current tax is tax on taxable profit, right? So taxable profit may be different from your accounting profit, and usually it is different. Deferred tax is impact of temporary differences. So we use the balance sheet approach in order to calculate those impacts and deferred tax liabilities and assets. Recognize deferred tax liabilities asset as per IAS 12 rules. Tax on revaluation goes to OCI, and as I showed you in the moment how to show you how to show this deferred tax in the beginning and in the end of the period, and how these differences that happened during the period is reflected in the notes, right? So tax losses recognized if recovery is probable. All right. If you want, we can solve some problem here. So these are the nodes. Identify tax base for each item listed in the, and then identify the temporary differences. Tax base. So if nothing is given here, you may find some information in the nodes as well in order to find the proper tax base. Okay. So let's say the development assets had brought forward cost of 70,000 at the start of the year. Amortization started on 1st of January in the current year, and it's being amortized on 10% straight line basis for accounting purposes. The company's tax advisors have said that the company can claim 42,000 as a taxable expense in this year's tax computation. So what does it mean? What would you do with this note 1? If you remember here, look, research and development, right? They have, and development brought forward cost, they had 70,000, right? At the start of the year, but this is the last year already. So at the beginning, it means that they had 70,000, now its carrying amount is 63. So they had 70,000 at the beginning, right, of the period, both for tax purposes and for accounting purposes. Accounting, carrying amount, let's say carrying amount in the tax base. So if they use the straight line basis, right, they have 7,000. They depreciated 7,000, but for these purposes, they are saying the company can claim 42,000 at taxable expense, right? So here they will have minus 42,000, right? And the carrying amount will be 63,000 in this case. In this case, yes, would be 70,000 minus 42. So here we have 28,000 carrying amount, and accounting we have, so in this case, 35,000 is taxable, right? Temporary difference. Taxable temporary difference. Land, right? What is about land? Land is 200,000 here. The land has been revalued during the year. It originally costed 150,000, right? It is not subject to depreciation under local tax rules. So originally costed 150,000 and it became 200, right? What we do with the revaluation, if you remember what we do, just take the revaluated amount, right? And as a tax paid, the original amount. So here we're gonna have just 200 minus 100 for the land. Land, we will have here 200,000 minus 150,000, and we're gonna have again taxable temporary differences, this minus this, right? All right, next, plant and machinery. Let's look at the plant and machinery, what they are saying about node 3. Okay, they don't have node 3. We just take this amount then. Carrying amount minus 90. Plant and machinery. Plant and machinery. 190,000. Yeah. 100,000. 90,000. Minus. And then we have taxable temporary differences, right? Plus. Okay, now we're gonna look at the receivables 4. So revenue is taxed when recognized. What we'll do? What does it mean? Revenue is taxed when recognized. Then it means that for trade receivables we have the same tax base, right? For the trade receivables, we have the same tax base as an accounting. So they don't have any temporary differences because we also recognize revenue as tax when they are received. 0 difference. Then interest receivable. Let's look at interest receivable. Interest is tax from tax relief when paid. Again, when paid. So we have interest receivable now. Receivable now 1,000. But for tax purposes, we don't have anything because when they are taxed when they are paid. But we have receivable. It's not the paid amount yet, right? So for tax base, we have 0. 1,000 minus 0. So we have difference again. All right. Now for the liabilities calculating. Okay, we have in liabilities fines, right? And interest payable. Fine, let's look at this. Note 6. Fines are not allowable for tax purposes. So, what does it mean? Because if it's liability, we put the sign minus. Fine, payables are not allowable, right? So, because of they are not allowable, you don't have any temporary differences, right? That's why you are also doing the same. If they are not allowable, then it means that you have permanent, right? Differences. So in temporary differences, you will have 0, right? Interest payable. Interest is the liability balance of the deferred tax. Interest is taxed when paid, right? Interest is taxed when paid. And that's why, again, for this interest, the same, you apply the same approach. And that's why if it's 9,300, then you put here 0 because for now, you don't have any tax base. But in the future, when they are paid, you will have tax base. My advice is also to put, if you are calculating for liabilities, already this sign, minus sign, because if you put the minus sign and you have minus, it will be deductible temporary difference. But if you put here plus, right, I mean, if it's liability, it's going to be deductible temporary difference. Okay? So when the carrying amount of liability is more than tax base, in this case here, right, 10,300 and more than tax base, 0, then you have deductible temporary difference for liabilities. A is done, calculate the deferred tax liability, right? And we need to also make this journal entry now. So we are calculating right now the deferred tax it's going to be deferred tax assets or liability. Let's look at this. First, we have here the differences of this one, right? 26 temporary differences will give us deferred tax liability, right? Liability. Based on this amount, right? Which are taxable temporary differences will give us deferred tax liability, right? And we are applying 30% because it said that 30% tax rate. So multiplied by 30%, right? 28,800, we're gonna have tax liability. And deferred tax asset. Only this one, right? This one multiplied by 30%. So net, as you calculate net, you see that we have deferred tax liability, right? Right? No, plus, we should plus. Net, we have deferred tax liability. And they are saying to show the movement Поработал дебет, там, deferred tax expense, да, и deferred tax liability. Ну, вот эта сумма будет идти сюда. Но если это у нас не первый год, по-моему, это не у нас не первый год, потому что я здесь видела, какая-то сумма была. On 1st of January 3300, видите, вот эта сумма была уже. Поэтому мы, если у нас уже эта сумма была, то мы должны разницу, да, посадить. For tax liability у нас была сумма эта. Значит, для того, чтобы у нас 27 720 стало, да, у нас, потому что 3600 уже есть, we need to deduct 3300, and we will have this amount. Да? А вот. Вот это тоже нужно учесть. Если у вас на начало есть уже liability, да, какой-то баланс, то вот это уже баланс должен быть на конец. То есть, чтобы этот баланс сделать на конец, вы разницу сажаете в проводку. Да? Okay, so this is the end, and it's about we learned all about the deferred tax for financial reporting purposes because there are other complexities that are related to deferred tax, but they are not within the scope of financial reporting exam. So far, this is enough for you to know for passing the exam.